Welcome to Tax Smarts Unlocked, the podcast for individuals and small business owners looking to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services, each episode is packed with insightful advice on proactive tax planning to help you navigate the complexities of tax laws. Here's your host, David Robson.
Welcome to Tax Smarts Unlocked. I'm David Robson, and today we're tackling one of the most overhyped, misunderstood phrases in the tax world, real estate professional. Spoiler alert, it's not a job title, it's a test. If you own rentals or plan to, this status can flip losses from frustratingly passive to powerfully useful. We'll decode exactly what the IRS looks for, why many landlords miss the mark, and how smart documentation and planning can put the rules to work for you. I'll cover the hour thresholds, material participation, aggregation elections, what counts, what doesn't, and practical strategies to capture deductions without stepping on audit landmines. Grab your notes and coffee. Why does this designation matter? Under Internal Revenue Code Section 469, most rental activities are passive. Passive losses can only offset passive income, so those juicy paper losses from depreciation often get suspended, carrying forward until you sell or generate passive income. Qualifying as a real estate professional is the doorway that can make your rentals non-passive if you also materially participate. When losses become non-passive, they can offset wages, self-employment income, and business profits. That can be a game changer in high tax years, or when a cost segregation study creates big first-year deductions. There's more. The 3.8% net investment income tax generally doesn't apply to non-passive income. Turn your rentals non-passive, and you may trim net exposure, stacking ordinary tax savings with a Medicare surtax win. Timing and planning matter. So, what activities even qualify? The statute covers real property trades or businesses, which include development, redevelopment, construction, reconstruction, acquisition, conversion, rental, operation, management, leasing, and brokerage. If your personal services are in those buckets, they count. Two quick nuances. First, simply owning property isn't a service. Doing the work is. Second, flipping property as a dealer is still a real property trade or business, but it may raise different tax issues like inventory and self-employment tax. For our focus today, rental real estate, operation, and management are the most common categories, and they're broad enough to capture meaningful hands-on tasks daily. Qualifying as a real estate professional requires passing two threshold tests for the year. Test 1, more than half of the personal services you perform in all trades or businesses must be in real property trades or businesses in which you materially participate. If you have a full-time W-2 job outside real estate, this first test becomes a tall mountain. Test 2, you must perform more than 750 hours of services during the year in those real property trades or businesses in which you materially participate. Both tests are annual, and both must be met by the same individual taxpayer. Think of them as the gatekeepers. If you clear them, you then apply the material participation rules to each rental activity to determine whether the losses are non-passive. No shortcuts, no rounding, and no "I feel like I did" hours. Filing jointly? The real estate professional tests are not a team sport. On a joint return, one spouse must independently satisfy both the more than half test and the 750-hour test. Spousal hours can be combined only for the separate material participation tests, not for qualifying as a real estate professional. Translation: one of you needs to carry the qualifying load. Next, the employee caveat. Hours you perform as an employee don't count unless you own at least 5% of that employer. So a salaried property manager with no equity cannot use those employee hours toward the 750. If you are a 5% plus owner, document that ownership in your services to make those hours count. Auditors check this detail with surprising vigor. Material participation is the second pillar. Even after you qualify as a real estate professional, each rental must be non-passive by meeting one of the 7 material participation tests. Highlights include: you participate over 500 hours. Your participation is substantially all the participation. You participate more than anyone else. You do over 100 hours and no one does more than you. Or based on facts and circumstances, you are regularly, continuously, and substantially involved. There are also tests for significant participation activities totaling over 500 hours across businesses. For rentals, the 500-hour, more than anyone, and substantially all tests are the usual winners. The catch: you apply these tests to each activity separately, unless you've properly grouped or made the special rental aggregation aggregation election. Without that, one busy property won't rescue a quiet one. Each property must stand on its own merits annually. Enter the aggregation election under Register 14699G. This lets you treat all interests in rental real estate as one activity for material participation. You make it by attaching a statement to a timely filed return, describing that you are making the election under the regulation and listing the properties or stating that it covers all current and future rentals. Why do it? It allows your hours across properties to combine, so a series of medium-effort rentals can collectively meet a test. Cautions. Once made, the election is generally binding for future years. Revoking it requires IRS consent. It can also spread risk. Material participation failure or facts in 1 year hit the whole group. Plan ahead before you file the election. What hours actually count? Qualifying time includes advertising vacancies, screening tenants, negotiating leases, collecting rent, scheduling, supervising, or performing repairs and maintenance, property inspections, bookkeeping, paying bills, managing vendors, responding to tenant issues, and substantive oversight of a property manager. Real decision-making counts, time that usually doesn't. Investor-level activities such as studying financial statements without operational decisions, monitoring the economy, or researching markets without acting. Purely educational seminars and networking with no immediate direct business impact. Travel time that is excessive or undocumented. And time spent on work you pay someone else to do unless you direct, review, and make decisions. Pre-acquisition work is tricky. Limited hours may count if they directly relate to an existing business, but general shopping or Zillow surfing does not. Be honest, be specific, and tie hours to outcomes. Documentation should reflect this practical distinction clearly. Great hours still fail without great evidence. The gold standard is a contemporaneous log, a calendar or time tracking app noting the date, property, task, and duration. Add brief descriptions that show decisions and outcomes, approved contractor bid and scheduled roof replacement beats, worked on property. Keep corroborating proof, emails, texts, invoices, bank statements, signed leases, maintenance tickets, mileage logs, and photos. If you supervise a manager, preserve agendas, directives, and approvals. Avoid creating logs after receiving an IRS notice. Reconstructed estimates are scrutinized and often discounted. Align facts across the return. W-2 hours, business schedules, and property activity should tell one story. Red flags I see. Heroic hour claims with full-time jobs, inconsistent property counts, years with minimal rent but large hours, manager-run buildings without evidence of oversight, and late or missing aggregation elections. Those patterns invite audits and undermine solid positions. Let's bust a few myths I see every season. Myth 1. Owning rentals automatically makes you a real estate professional. False. Ownership isn't a service, and the tests are not optional. Myth 2. Having a real estate license seals the deal. Nice credential, no bearing on hours or participation. Myth 3. Using a property manager disqualifies you. Not true. You can qualify if you provide substantive oversight and decisions. Myth 4. Spouses can pool hours to hit 750. They can't. Only one spouse must meet both threshold tests. Myth 5. A demanding W-2 job still leaves plenty of nights and weekends. Maybe, but the IRS will ask for proof, and arithmetic is undefeated. Myth 6. Every hour of travel counts. It doesn't, and padded logs crater credibility fast with revenue agents. Special situations can change the analysis. Short-term rentals, where the average stay is 7 days or less, are not treated as rental activities under Section 469. That means the real estate professional tests may not be required, but you still must materially participate to avoid passive loss limits. If you provide hotel-like services, daily cleaning, linen changes, meals, you're even more clearly running a business, with different risks and potentially subject to self-employment tax. Triple net leases skew the other way. They're usually passive, and hours are hard to justify because tenants handle operations. Consider modifying leases to retain meaningful responsibilities. Pre-acquisition time rarely counts unless tied to an existing business plan for your current rentals. And remember, commuting-style travel and scenic detours don't qualify merely because you discussed cap rates in the car. Tie hour to active management, not passive ownership or investment research. Now, strategy. If you qualify and materially participate, pairing rentals with cost segregation and bonus depreciation can front-load deductions. A $50,000 paper loss that would be suspended as passive could offset W-2 or business income once non-passive, and it may also reduce NIIT. Case study. Spouse A works full-time as a physician. Spouse B manages 5 rentals, makes the aggregation election, logs 900 qualifying hours, and materially participates. A cost-seg study creates a $50,000 loss. It offsets the household's wage income this year. Guardrails: avoid services that morph rentals into a hospitality business subject to self-employment tax. Year-end checklist: assess logged hours, schedule decisive tasks to cross thresholds, decide on aggregation, finalize cost-seg timing, document oversight of managers, and have a pro-model alternative scenarios and safe positions. Also map NIIT exposure once losses turn non-passive to optimize brackets.
Thank you for joining us on Tax Smarts Unlocked, the ultimate podcast for individuals and small business owners ready to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services, each episode has been carefully crafted to provide you with insightful advice on proactive tax planning. By adopting a smarter tax approach, you can focus on what you do best, growing your wealth and your business. We're here to guide you every step of the way. Don't miss an episode. Subscribe to Tax Smarts Unlocked on your favorite podcast platform and unlock the secrets to confident tax planning. Remember, it's time to take control of your taxes and unleash your full financial potential.